So let's start with a truth bomb. Home ownership today feels difficult. It feels like climbing Mount Everest difficult, blindfolded, in sandals. But the main issues right now are affordability and inventory. It is really, really tough to overcome those two things, but the ones who do, who take that bold strategic action, even in this wild market, are the ones who are going to win. Now, even today, right, I had 26, 27 people register for this event, and how many showed up? Like 6, 7? And you're here because you're ready to conquer this real estate market in 2025. And while it's a battlefield out there, today's webinar is going to arm you with the strategies that you need to afford your dream home without feeling like you're stuck in a mortgage payment, or the odds are stacked against you, or that you've depleted all of your savings just to get in the door of a home. So once we've got these strategies, here's the big question. Are you going to sit on the sidelines and let these opportunities pass you by, or are you going to take control of your future? And just like everybody that's on this call right now, there are fewer people out in the market today as well. And yes, it's true. There's fewer inventory and fewer homes depending on the market that you're in, but there are definitely some opportunities out there right now. And the two things that we're really worried about, most clients are worried about, is affordability, high rates, high prices, and inventory. And I'm not going to sugarcoat it. It's a problem. By the end of this webinar, I think I'm going to be able to give some pretty good solutions and have you walking away with actionable strategies to beat the market. So let's get started. I'm going to ask that you guys work with me on this, because these are the most common problems out there. So in order to help buyers overcome these challenges, whether it's strategies like the 3-2-1 buy down or personalized marketing, market insights, I'm here to strategize with you guys to create solutions with you guys for our clients, for these buyers and for sellers. There's a lot of people that are trapped and are becoming either accidental landlords or feel like they have those handcuffs from being locked into a really low interest rate. So I think that the secret to success in real estate is knowing your market. And, I know we have a couple of Jersey people on here, so I'm going to take Bergen first, but I'm going to actually go over Rockland as well, because in both of these areas, appreciation is soaring. And it's far outpacing the national average and the historical average. So when you have this kind of low inventory and high demand, being in a prime location right outside of New York City means this should be a really good opportunity for years to come. Now, what I focus on, and I present this to each and every one of our buyers on our loan review calls, so that they have a pretty good understanding and are seeing the bigger picture here, because a lot of people don't think about things this way. So if we look in Bergen, we have a $740,000 median sales price. And even using a more historical, we'll use a 5% annual appreciation, right? If we go back the entire time that they've been tracking this, it's about 4%. Over the last 5 years, it's closer to 8%. So I'm saying 5% annual appreciation. If you bought the median priced home today for $740,000, in 5 years, you've made almost $200,000 just for living in a house and making your mortgage payment. So that is the way to build wealth. That's the way that most people end up buying their dream homes, right? Unless you are, an athlete or you hit the lotto, right? Most people make the majority of their money in terms of being able to move up to bigger homes through appreciation. So this is a really important stat, and this data is so helpful for buyers to see and to understand. Now, the other thing that is important to understand is the supply and demand. And in Bergen, where there's roughly 1 million people, out of those million or so people, about 69%, or 660,000 people already own a home. So there's roughly 400,000 or 375,000 people who are renting. Out of those people, about 75,000 can qualify and afford to purchase a home. So we have 76,000 people just in Bergen County who could buy homes, but we only have about 2,800 homes being built every year. So that's what's creating this bottleneck. And if we look at the numbers year over year in terms of active listings, right now there's just under 600 active listings. That's down 57% month over month, 42% from last year. There's only been 41 new listings in the last week. So this is why I feel like as rates come down and more people do qualify and are willing to purchase homes, I think prices are going to continue to go up at these really high single digit or even double digit appreciation rates. I'm going to pull up Rockland too, just because I know we have some Rockland people on here and I want to share those numbers because they're just as good, if not better. So median price in Rockland's about 720. The 5-year average here is over 8%. And if we look at that same median priced home today, 5 years from now, again, you made $190,000 at a 5% annual appreciation just for living in your home. The inventory here is a little bit better, but the construction is a lot less. So while we do have fewer people living in Rockland County, the number of homes that are being built it's a joke. There's 313 new homes built in Rockland every year, mostly because we're overdeveloped. And when we look at the active listings, this is actually up from last year, 14%. So that's a good sign. It's just still not enough. Here we have 65% of people who own their home and another 30,000 who qualify and want to buy homes. But we're only getting, 313 new homes built every year. So we're relying on this inventory to turn over. And that's really why we need these interest rates to come down. There is a path towards lower rates. We got some good news today in terms of the ADP jobs report that came in below expectations. It seems like right now all of the jobs being created are in the government. Every other sector, all the private sectors are down. So that is going to trickle through eventually, and we should start to see more rate cuts and mortgage rates actually coming down as well. I think I lost it here. Let's see. Okay, so we talked about the market. Now let's talk about the cost of waiting to buy a home. And this is really important to know because it may cost more than you actually think. Every month that you wait is equity you're not building, it's wealth you're not creating. And let's be real, when rates drop, the competition is going to skyrocket along with prices. So the smart move, what we're telling all of our buyers to do is act now, get in the door, build equity, and then when the rates drop, you already own your house. Now you refinance. That's going to be a tremendous amount of wealth creation by acting sooner rather than later. And here's the data on that. If you were to purchase a home today at the average home price in Jersey, about $740,000, and we see a 5% appreciation, next year that house is going to be worth $778,000. If you were to wait for rates to drop a full point to next year and bought, you're saving $141 a month because of the higher price and the lower rate. So you're only saving a total of $1,692, but you're also gonna be renting for a year further as well. So we're not even accounting for that here. So you're saving about $1,692 in total monthly payments versus if you were to buy now and next year made $38,000 in appreciation, then you take out the loss of the 12 months of paying the higher rate and the cost of refinancing, you're still benefiting by buying today in the tune of about $32,000. So it really does cost a lot more than most people think to hold off and wait for these lower rates. Now, I just spoke with a client yesterday who bought a house 2 years ago. When she came to me, she was on a 2 to 3 year plan. They needed a place to live. The husband had to work in New York at that time. Family, childcare, everything is in Jersey. So they're getting ready now to sell this New York house, and look at the numbers. So she bought 2 years ago a really great home for $620,000. She did do some minor work. I would say I think she put about $25,000 into it, and now she's getting ready to list that house for $750,000. And let's be honest, it's in a great area and it's relatively updated. It's probably going to sell for over that. So that's at least $130,000 in gain in just 2 years. That's the power of transacting, getting in the market, and leveraging the bank and using the bank's money to build wealth. Now, I like to break it down in terms of ROI, because when you're thinking about investing, that's usually what you're looking at. If you're debating on, hey, should I invest this savings, this money into real estate or into the stock market, right? What's the ROI? So with this particular case, Caitlin put down 10%, which would have been $62,000, made $130,000 in equity and appreciation. That's a 209% return on that initial investment. There is no other investment out there that you're going to be able to make $130,000 in 2 years by only investing $62,000. And that's the power of leverage by using the bank's money, right? So how many buyers are we working with right now that just aren't understanding these numbers and this data? The biggest objection, and let me ask you guys, the biggest objection I see most of the time isn't that people can't afford the higher rates and the higher monthly payment. They can. They're just not very happy about it, to the point where they continue to sit on the fence. So what this solution is the 3-2-1 buy down. Now, I'm going to get into like the nitty gritty of how we can actually get this done, right? Because everybody knows on this call, at least, that in order to do this, we really want to get a seller concession, which on a competitive property is difficult. But when we put this together the right way with the buyers up front, so that they understand that they're actually signing up for these rates from today, this 7.25% interest rate on a $740,000 house with $18,000 in taxes, their monthly payment's $57.38. That's the monthly payment. It's going to cost them $167,000 to close on this deal. They have to be okay with these numbers, knowing that that's the real math. This is the eventual numbers that they're going to get to if things don't go our way, meaning that rates don't drop sometime in the next 3 years. But even if they don't, would you rather save $1,000 a month in your first year of owning a home, or lock yourself into this higher rate and higher payment over that same amount of time? Every buyer that I talk to, literally every buyer that I talk to, chooses they would rather have the lower rate and they'd finance the concession. So the way that this is going to work is we're going to add $30,000 to the sales price. So the seller's still netting $740, but on paper it's $770. That extra $30,000 is being financed into the loan. 100% of that money is our borrower's money. The $28,994 at closing that you see here goes into a separate escrow account. And that all that is it's the difference in payments between the discounted rates and the full rate over the course of the 3 years. So at any point, if rates drop and they refinance, there's going to be a nice amount of money left in this buy down account that is going to go directly back to that borrower or to their principal on their new loan. So 100% of this seller concession is being used for paying down the mortgage or covering the closing costs. Now, what this does is it saves $1,000 year one going into a new home. That's a lot of money. That's a lot of money for anybody. And especially for a buyer who is walking into a new house and, potentially leaving a really low rate mortgage as it is, but they outgrew the space or they need to move, or any first-time home buyer that could ease into these higher rates is going to really benefit from having this runway that they can adjust. God willing, they'll continue to make more money, and with a little bit of help from the economy and the markets, these rates will come down, and hopefully they'll never see this $5,700 mortgage payment. But I would never do this unless somebody was 100% willing to proceed at the $740 with the 7.25% rate. We don't do these contingent on a 3-2-1 buy down because we can't guarantee it. We can't guarantee that the seller is going to accept it, and we can't guarantee that the property is going to appraise. Most of the time, both of those things do happen. Okay, then, so what happens next? After that first year, you're still not convinced? Well, over time, you're going to save even more money, right? In year two, you're still saving. That rate does go up to 5.25%. The payment does go up. And then by year three, you're still normalizing, getting adjusted into the new house and at these higher rates. Again, I don't have a crystal ball, but I would be very confident that within the next 3 years, there's going to be an opportunity to get a rate under 6.25% that you can have permanently and set up that 30-year fixed mortgage for. I don't know exactly when, and I don't know exactly how low. But if anything, what we've seen from September is there's going to be opportunities. You just have to be ready to act quickly. So how do we do that? Well, when we go to closing, we are offering all of our clients a $3,000 refinance credit. This does not expire. And basically what we're doing at closing is setting a target that either a rate or a payment that our clients want to see. And as soon as we're approaching that rate or that payment, we're going to automatically start that refinance application. And then we're going to cover the majority of their closing costs with this $3,000 credit. So depending on where their house is, New York's a little bit more expensive. New Jersey, this is going to cover just about everything. Either way, they're going to skip 2 mortgage payments through that process, and they're not going to have to come out of pocket with $1. So this is the system that we're using to get buyers into homes today and stop sitting on the fence and waiting for these lower rates that hopefully will come, but we don't know when, and we don't know what the rest of the environment or the market is going to look like. So, like I said in the beginning, we want to work together. We want to help more buyers overcome these challenges, whether it's strategies like the 3-2-1 buy down, personalized market insights, real estate report cards, loan estimates, whatever it takes. I'm here to partner with you to create successful stories for our clients. Now, I think I really kept that at 22 minutes because we started a couple of minutes late. Am I right?
That was pretty close.
Now, I know I just covered a lot of info and data, but I like these shorter presentations because nobody wants to be an hour long on a Zoom call, especially. One thing in person, but not on a Zoom call, right? So let me open up the chat. Any questions in there? Does anybody want to come off of mute? And does anybody have any insights or questions or anything that they want to throw out there for me?
I thought that was a great explanation of how it's good to just get in at some point, get in now and let time kind of let the equity build on, what you purchased. And also the 3-2-1 buy down, we spoke before about how that's really helped some of our clients, get what they need at a rate that works for them. It's really good for properties that have been sitting for a while. It's for the clients that we've used it on, they've been extremely happy. And I know we've been very nervous about appraisals working out. And knock on wood, things have so far worked out. So definitely going to continue to try to do the 3-2-1 buy down again and in the future for our clients.
So Chris, I know I'm just off the top of my head, the ones that stand out the most, and I know we've done a bunch of these, but the ones that stand out the most were up in Orange County. And they were new construction, and they were selling for premiums. And we were still able to add that concession in and get the number on the appraisal, which is freaking awesome too, because that means that, these buyers are going into these houses with equity. We're just using that money now rather than just having it on paper somewhere. We're actually taking that money and using it so that it's making their lives easier and it's allowing them to get on with their lives. Because I know for a fact two of those deals probably would have done it without the buy downs, but it really would have been a lot more difficult based on their situations.
Yeah, it would have been a stretch for both of them if they didn't do the buy downs. And they were both new construction, like you said. Orange County seems to have, obviously has way more land over there that's buildable compared to Rockland. So, for buyers that want to look in Rockland and then they get priced out, some of them really want that new construction house. They got to be willing to, deal with being in Orange County sometimes. But we've been finding some first-time home buyers deals for new construction homes in Orange County with this 3-2-1 buy down, which almost feels like kind of a slam dunk. I mean, I know they maybe prefer to be in Rockland, but I mean, to get a new construction home at a price they like, at a rate they like, it's very hard to get in any market, especially in the tri-state.
The younger people that we're dealing with more and more are open to moving further up, a little bit further away from the city because of the affordability, because of what you're getting up there. And but the deals here in Rockland and in Jersey as well, not having any issues with appraisals anywhere, knock on wood. The strategy behind how we're actually making this happen for buyers really does come down to them being in alignment with the real numbers. Like I said, if they're if they really wouldn't buy that house if they didn't get the buy down, they shouldn't be buying that house, right? So the way that we propose this is, especially in a competitive situation, we're not putting that concession and that buy down in our initial offer. We're going in with our best foot forward with the cleanest and easiest deal. Once the offer is accepted, and typically in New York, when the deal gets to the attorneys, that's when we'll ask for the concession and approach it like, hey, we're not going to reduce the price if the house doesn't appraise. This is going to help the buyers to obtain a rate in the 3s or 4s, and there's no risk to the seller. We're going to pay the transfer tax, the difference in the transfer tax, If it doesn't appraise, we're going to reduce the concession. Nothing changes for your seller. And for whatever reason, the attorneys have a much easier time of explaining that or just getting the sellers to agree to it. And it's been a really successful strategy as opposed to battling it out up front going in with these concessions. So I think that's the move. I think that's the answer for the time being on how we make housing more affordable for not just first-time buyers, but especially for move-up buyers that feel that lock-in effect from already owning a home at a ridiculous rate and still needing to get out and still needing to move on with their lives. This is a great way to bring them along so that they don't have to go right from a $3,500 payment to a $5,700 payment. And that's all I got for you guys. Today, at least.
Great job, Anthony. A lot of informative stuff. Appreciate it, bro.
No, my pleasure, man. Thank you, Christian, Mark, Shane, Linda. Thank all you guys. Veronica, thanks for hopping on here. I will, if you'd like, I can send this link over to you guys if you have any clients that you think would benefit from this. Better yet, though, is just DM or just text me or call me with anybody that you think would really benefit from seeing a real estate report card or a cost of waiting analysis, a temporary buy down breakdown. It's so much better if you really make it specific to your client's needs. And there's just a few of us here, so it would be a piece of cake for us to help to handle that and to help you to help these clients.